Everybody, we got another video, a few more charts for you here. Markets continue to rally as we move through October. Show you a few things. A similar case to what we've seen before, but it continues to get extended on the tech names overperformance to the rest of the market. So you can see here, this is looking at a quality index, which includes names that have less leverage, higher return on equity, generally seen as more defensive stocks. And you can see the underperformance that they've had to the rest of the market so far here, down 10.4% at the moment. And of course, looking back on the left side, April 1999, it was down 11.4% as far as underperformance of those quality names to the tech sector. And you can see the flip of that when markets have corrected, of course, the 2000 crash in the markets, and then the financial crisis, 2009 as well. So you can be a little wary there on how the tech names, the higher growth names, have been outperforming, and another case for diversification. Here's another similar chart, but looking at the consumer staples. So again, look back to March 2000. We haven't been as low as we are right now as far as underperformance of those more defensive consumer staple names compared to the rest of the S&P 500. And part of that is what I'll show you on the next chart, the overperformance of these stocks and how big these tech companies have gotten to be a percentage of the S&P 500. We're at all-time highs. I've shown this chart a few times. It continues to get worse as far as diversification in the S&P 500. When you look at the market cap, 21.4% of that index of 500 names, 500 companies in the US is now Nvidia, Microsoft, Apple. So if you're holding an S&P 500 ETF, know that over 1/5 of your investments are in just 3 companies, and they're all similarly tied to and correlated together. So if we do get a market correction, then those are likely the names moving down, as we saw in the previous charts. Now, not to say they can't continue to go up or that they're bad companies, but a case for diversification into other sectors, other geographies, other sections of stocks, as in small caps, things that aren't correlated to the market. You look at real estate, maybe infrastructure, alternatives, those sorts of things, to get through some volatility that we're inevitably going to see. We've had this market rally, but there are corrections along the way. It's almost hard to remember right now, but we had a big correction in March, April of this year that's been blown right through back onto the upside. But these corrections do come, so a good case for diversification. On the positive side, looking at this current bull market that we've seen, we're now hitting 3 years since the length of this bull market, back to October 2022. Again, if you remember, we had a negative about a year through most of 2022 as the markets were weak. We've been on this 3-year bull run, and any bull run that we've seen that's lasted longer than 2 years, so take out things like the pandemic, after the pandemic initial drop, didn't last 2 years before the 2022 drop. But over the last 50 years, we've had 5 other cases where bull market has lasted over 2 years. And in each case, it's gone on to be at least a 5-year bull run. And in a couple cases there, you can see 11 years and over 12 years for the markets to run up until 2000. So which one do we think we're going to follow in this case? The most similar one right now is looking like that post-financial crisis run that we've seen. We're in a similar territory after 3 years. We've had some corrections along the way. There will be more to come, as you can see. It's not a straight line up when you're in a bull market, but there is potential that this rally continues. As we all know, global economies are weak, and there's lots of trade tensions out there, so lots of news and possibilities of corrections in the markets with the negative news. But it's a case, again, to not be overly worried that the markets can't continue because we've been on a run for the last 3 years. There's definitely historical cases that have these bull runs lasting longer, but there will be some corrections along the way. huge case for diversification, like we saw in the first few charts, moving into more global portfolios, looking at other pieces, other sectors, other geographies that you could add to keep that return level where you need it, but reduce that risk level if possible. So I'll leave that with you there. One interesting chart that you can pass along at your coffees with friends. Right now, the Microsoft bonds, in certain cases, have a lower yield than equivalent Treasury bills for the U.S. government, which is an indication that basically investors are saying we'd rather put our money, our safe money, in Microsoft than in the U.S. government. So something you almost never see the U.S. government being as stable as it should be. Historically, the safest place to put money. But some investors are saying, you know what, I'd rather give my money to Microsoft and worry about whether they will pay me back than give it to the U.S. government and have them pay me back. So interesting piece that yields are actually slightly lower on Microsoft bonds than on the equivalent US treasuries. So little tidbit there. I'll be back with another video soon. Take care, everybody.